Hello friends, I'm your Sacharazu Kolluru. I know all you successfully completed your all the examination, whether it is a group 1 or a group 2. So this video lecture is all about May 2022 CA Inter Advanced Accounting P5 question paper analysis. I already released uh, P1, that is accounting question paper analysis video. So this lecture is exclusively related to paper number 5. So as like P1, regarding P5, here I'm not dealing answer for any question. So then what you are trying to discuss here, sir? The questions which they asked in the examination, whether it was properly covered in our material or not. If it is covered, it is which problem or from which concept they actually asked. And the key points, what they asked, and which mindset you should require at the time of answering that particular question. So then how this lecture is useful for the students? If the students who already gave their attempt, this lecture is useful to cross verify the answers done by them. They are made it in proper way or not, because the key issues I'm going to discuss here. And the students who are going to give their attempt in November 2022, this is a highly useful lecture, because the way of thought process you should need to be adopted in your mind at the time of making answers to a particular questions, and whether our material is sufficient to cover the entire examination question paper or not, because it gives a lot of confidence at the time of uh, attempting answers as well. Okay, and just I want to give a one comment before proceeding with the lecture. May 2022 P5 advanced accounting question paper is almost covered 90 marks directly from our material. And the question paper is also not that much of lengthy. The question paper you can crack within the given reported time. And the questions which they asked from the basic points, there are not two adjustment tested in the examination. The basic points just they touched. And while compared with P1, P5 is little bit easy. So that means P1 is easy tough? No, the tested P1 paper from analytical mode. So you should require little bit analysis to crack the problems which given in P1. Now coming to the P5, all the problems, almost the direct problems. I already used the word 90 marks, almost more or less 90 marks are the direct questions. So the paper is given for 120. Out of 120, 90 marks are direct questions. You need to attempt only 100. That means 90% of your attempted questions will be the direct questions. That is the point I am emphasizing here. Okay, without wasting much time, let me directly entering into the question paper. So, question number 1 is compulsory, which they asked for 20 marks. 4 questions they are giving here. So out of which question number 1. Sir, question number 1 is related to AS5. They asked from AS5. 1 second. Yeah. So the question is asked from AS5. What the question is all about, let us have a look. TQ Cycles Limited is in the manufacturing of bicycles, a labor incentive manufacturing sector. In April 2022, the government enhanced the minimum wages payable to workers with a retrospective effect from 1st January 2022. Okay. Due to this legislative change, the additional wages for the period from Jan 2022 to March 2022 amounted to 30 lakhs. The management asked to finance manager to charge 30 lakhs as prior period item while finalizing the financial statements for the year 22-23. Now we are in the year 22-23. In the year 22-23, the additional wages we are going to record under the prior period item. No, prior period items are those items which related to the previous periods expenses or incomes occurred due to error or omission made in that periods. Am I right? So prior period items related to previous years, which are recorded in the current year due to error or omission. But is it recorded due to error or omission? There is no error or omission. So that's why which is not a prior period item. Further, the finance manager is of the view that this amount being abnormal should be disclosed as an extraordinary item in the profit and loss for the financial year 21-22, which is not an extraordinary item. Extraordinary activities are those activities which are clearly distinct from ordinary activities, which clearly covered under exceptional item. Exceptional is an ordinary item only. Exceptional is an ordinary item only, which is a direct question, guys. Such type of question we already dealt in our accounting standard 5. I clearly mentioned here question number 3, sub question 2. If I directly show that question in our material, you may surprise, which is a direct question asked for 5 marks. Just give some time space to me. I'll open that one in our material. So which is AS5. You can directly open page number 38. Okay. Where come to question number 3, sub question 2. Come here, guys. Where the question is, company signed an agreement with an employees union on 1/10/2012 for revision of wages with retrospective effect from 30th/9/2011. This would cost the company an additional liability of 5 lakhs per annum. Is it disclosure necessary for amount paid in 2012-13? That question was designed like that in our material. But here directly just they asked that, sir, whether it is extraordinary item and whether it is prior period item. It is not a prior period item. It is not an extraordinary item. It is an exceptional item, which is an ordinary activity only. The reason also I clearly gave in our printed solution. So which is a printed solution, guys? You can open AS5, right? Yeah, you can check here. Sir, revision of wages. Please, all of you concentrate this paragraph. Revision of wages took place on 1st October, so and so. Therefore, wages payable for the off year and the additional wages cannot be taken as an error or omission, which is occurred not due to error or omission, which is due to the revision of wages. That's why which is not a prior period item cannot be taken as a prior period item. The same similar question. And additional wages of liability should be included in the current year's wages under exceptional category. It is not an extraordinary item, which is an ordinary activity only, because exceptional is also ordinary. It may be mentioned that additional wages is an expense arising from the ordinary activities of the company. Such an expense does not qualify as an extraordinary item. However, as per AS5, items of income and expenses within the profit and loss from ordinary activities are of such a size and nature or incidents that the disclosure is relevant to explain the performance of the enterprise. The nature and amount of such items should be disclosed separately. Do you understand? So that means, first, why it is not an prior period item you should need to disclose. After that, why it is not an abnormal, that is why it is not an extraordinary item also you need to disclose. Then why it is exceptional also you should need to disclose. That means you should need to give the definitions of prior period items, extraordinary items, as well as exceptional items. Then you can give the conclusion. That's it. Do you understand, guys? The same question we already done in our syllabus and in the material we already covered. Okay. Next, come to question number B, guys. Here, question number B is from AS20, which related to calculation of EPS in case of bonus issue, guys. First, let me read the question here. Which is a listed entity on 1st April 2021 had the following capital structure. 10 lakh equity shares are there, face value 1 rupee, total worth 10 lakh. Preference shares are also 10 lakhs, 10 rupees face value, total worth 100 lakhs. During the year 21-22, the company had a profit after tax of 90 lakhs. The given information is PAT. On 1st January 2022, that means in the year 21-22, NAT made a bonus issue of 1 equity share for every 2 equity shares outstanding as at 31st December 2021. That means as at 31st December 2021, outstanding number of equity shares are 10 lakh. So bonus issue is 2:1 means, sorry, bonus issue is 1:2 means that is for every 2 equity share they are going to issue 1 bonus share. That is number of bonus shares are 5 lakh equity shares. And the effective date of the bonus shares are first day of the previous reporting period. Why the effective date of the bonus shares is first day of the previous reporting period, guys? I already told you, whenever the bonus shares are issued, along with the normal basic EPS, we should also calculate the adjusted basic EPS for the purpose of knowing the correct comparison. Am I right? So that's why we should consider these 5 lakhs, which are effective from the first day of the previous reporting period. On 1st January 2022, NAT issued another 2 lakh equity shares of 1 rupee each at their full market price of 7.60 per share. So face value is only 1 rupee per share. Fine. So NAT shares were trading at 8.05 per share on 31st March 2022. Further, it has been provided that the basic earnings per share for the year ended 31st March 2021 was previously reported at 62.30, which is the previous year basic EPS. That means for 2021 basic EPS is given at 62.30. You are required to calculate the basic earning per share to be reported in the financial statements of NAT for the year ended 31st March 2022, including the comparative figure in accordance with AS 20. Now, for the year 21-22, first you can calculate the basic EPS. PAT given, from PAT, what you should need to reduce? You should need to reduce preference dividend. Then only you will get earnings available to equity shareholders. Sir, there is no dividend distribution tax concept was given in the problem. That's why you can ignore. So you can reduce the preference dividend. Preference dividend, how much? 100 lakhs into 8% means 8 lakhs. From 90 lakhs, if you reduce 8 lakhs, then earnings available to equity shareholders equal to 82 lakhs in and around. Then you need to calculate the weights. Weighted average number of equity shares. 10 lakhs into 12 by 12. For the entire year, they are outstanding. Now coming to bonus shares, these 5 lakh shares are also outstanding for throughout the year. These are outstanding since the inception of the last year itself. That's why for the entire current year also these are outstanding. Now what about these 2 lakh shares? These 2 lakh equity shares are outstanding for only 3 months. Now you can calculate the weighted average number of equity shares. That is 15 lakhs plus, that is 10 lakhs plus 5 lakhs, 15 lakhs plus 2 lakhs into 3 by 12. How much? 2 lakhs into 3 by 12. That is 50,000. So the total number of veins are 15 lakh 50,000 and the earnings available to equity shareholders are 82 lakhs. So 82 lakhs divided by 15 lakh 50,000, then you will get basic EPS. Right, guys? How much it is? 82 lakhs divided by 15 lakh 50,000. Just I'm working. I think so, which is 5.29 like that I got. 5.29. But we should not compare 5.29 with 62.30. The reason is whenever bonus shares are issued, we should need to work out the adjusted basic EPS. Now, how to calculate the adjusted basic EPS? Basic, that is current year earnings divided by, previous year earnings divided by previous year wins plus current year bonus shares. Now you can calculate the adjusted EPS because in the problem, it is clearly given that along with the current year EPS, you should also work out the including the comparative figure in accordance with AS 20 earning per share he is given. Am I right? Sir, then how to know the adjusted EPS, sir? Adjusted EPS equal to last year earnings divided by last year wins plus current year bonus shares. We know already this figure, that is last year earnings by last year wins. We already know the fraction itself is 62.30 they given. Now if you divide that with the bonus shares, then you will get the adjusted EPS as well. How to calculate the adjusted EPS? I already informed you in the classroom itself, the same problem, just they tested. Next, explain why bonus issue of the shares and the shares issue at full market price are treated differently in the calculation of basic earnings per share. Sir, why the bonus issue of the shares are differently adjusted with the shares issued at full market price? Because we can assume the effective date of the bonus shares will be the first day of the previous reporting period, but the effective date of the shares issued in the current year will be the remaining period of outstanding. So that's why bonus shares can be added fully, because the weight we can consider it as 12 months, irrespective of the period at which, irrespective of the time at which they are issued in the current year. But coming to the other shares which are issued at full market price, the outstanding period is depending upon the date of issue of such shares. In the given question, as on 1st January 2022, 2 lakhs equity shares are issued. That's why the weighted average period we consider are 3 months only. That is the difference in case of bonus issue and the other issue. That is the reason why we are differently adjusting bonus shares from the other shares in calculation of basic EPS. So again, this question is for 5 marks, sir, which is also a direct question we seen from question number 3 of our material. I'll show that. Just give some time. I'll open our material. So as 20, you can go for 17th page directly, where you can open question number 3. Similar question, guys. Similar question, not the same question, similar question, where if you observe bonus issue is there, and you can calculate the basic earning per share. What is the difference? There is no difference at all. So here also net profit given, there also net profit given. So, but along with the net profit, here preference shares are also given. That's why you need to reduce the preference dividend to get the earnings available to equity shareholders. Apart from the bonus issue, some other shares are also issued. That is the only difference, remaining same to same. Next, come to the next question, guys. This question is from AS29. Both the questions actually we seen. Totally 2 cases are given. If you really remember, AS29 various cases we discussed apart from the questions which included at the end of the chapter. We also discussed certain important cases under AS29. Those 2 are directly asked from such cases. Out of which, what about the first case and what about the second case? First, let me read. So the company is in the process of finalization of the accounts for the year ended 31st March 2022 and needs your advice on the following issues in line with the provisions of AS29. So as per the provisions of AS29, just they are asking our advice. On 1st April 2019, the company installed a huge furnace in their plant. The furnace has a lining that needs to be replaced every 5 years for the technical reasons. At the balance sheet date 31st March 2022, the company does not provide any provision for replacement of lining of the furnace. The company does not provide any provision. When you should need to create a provision, there should be a present obligation. If there is no present obligation, no need to create any provision. Now you should need to check present obligation exists or not. Sir, now furnace means a particular equipment which where the chemical reactions are in generally happening. So to get the proper chemical reactions or to occur the proper chemical reactions, the coated, the equipment is ultimately coated with a particular lining. That lining should need to be replaced for every 5 years once. But now 1st April 2019 to 31st March 2022, it took only 3 years. That means still 2 years balance is there. At the end of the 3rd year, no need to replace the lining. No need to replace the lining means there is no present obligation. If there is a no present obligation, no need to create any provision. So that's why the accounting treatment provided by the company is as per AS29 only. And if the same question they also ask, sir, for example, now you are not at the end of 31st March 2022, you are at the end of 31st March 2024. Now, is there any necessity to create a provision? At that point of time also, there is no necessity to create a provision. Do you know the reason? Sir, I will not replace the coating. I mean, what is that? I will not replace the lining. I will completely replace the furnace. My future actions will decide whether I incur expenditure on lining or not. If my future actions completely depending upon incurring on the lining, then how you can treat the present obligation exist? My future actions are independent of incurring of the expenses, then which I can be treated as a present then at that circumstance I can treat it as a present obligation is exist. Do you understand, guys? So the same thing, the same thing is discussed in the classroom environment, and for your confidence I will show the same question as it is question I discussed. I'll open that. You may surprise, guys. The same questions I already discussed is 29, right? Which is 151 to 171. You can put here 171. Okay, come down. So you can check here case number 9A. Refurbishment cost, no legislative requirement. If furnace has a lining that needs to be replaced every 5 years for the technical reasons at the balance sheet date, the lining has been in use for only 3 years. The same case was actually developed in the exam paper as well. So 2019, 2022, only 3 years expired, right? Tell me, guys. Next, present obligation as a result of the past obligating event. There is no present obligation. There is no present obligation. Conclusion, no provision is recognized. The cost of replacing the lining is not recognized because at the balance sheet date, no obligation to replace the lining exists independently of the company's future actions. Even the intention to incur the expenditure depends on the company's deciding to continue operating the furnace or to replace the lining. It can go for replacing of the lining, then it may incur. But it can go for replacing of the furnace, no need to incur the expenditure on the lining, right? So that's why the incurrence of the expenditure is completely depending upon the company's future actions. That's why there is no present obligation at all. That is the point they tested. Next, coming to the case number 2. Case number 2 is directly asked from this one. That is court case. If you read, then you can understand. A case has been filed against the company in the consumer court and a notice for levy of the penalty of 50 lakhs has been received. The company has appointed a lawyer to defend the cause for a fee of 5 lakhs. 60% of the fee have been paid in advance and the rest of 40% will be paid after finalization of the case. There are 70% chances that penalty may not be levied. First, you can think about the penalty. After that, you can think about the fee. First, penalty. Sir, how much probability is there to pay that penalty? Only 30% probability is there to pay the penalty. Sir, there is a present obligation arised due to the past event, but the probability is pretty much low here to pay that obligation. If the probability is low or there is no probability, then you can create a contingent liability, which is the definition of the contingent liability. What is the definition of contingent liability? If you observe here, just a moment, please. Come to the definition of contingent liability. Sir, contingent liability, it is not probable that outflow of resources embodying economic benefits will be required to settle the obligation. It is not probable. There is very less probability is there to pay the damages. Then you can create a contingent liability. That is with respect to the damages. No need to create a provision. But with respect to the fee, out of 5 lakhs, you already paid 60% pieces. What about the remaining 40% fee? For that 40% fee, you can create the provision because it is clearly given that remaining 40% will be paid after the finalization of the case. As per the agreement entered in between the company and the lawyer, you should need to pay the remaining 40%. That is 5 into 40% is 2 lakhs. At the end of the case, you should need to pay, right? That's why for the 2 lakhs, you can create a provision. For damages, no need to create any provision. For contingent liability, you can create, but for legal fee made to the lawyer to the extent of 2 lakh, you can create as a provision. The same thing actually I discussed in the classroom through this case, guys. 1 second. Where it is? Yeah. Through this case. Below certain cases I discussed now. A court case as on 31st March 2005. If you read the same from here to here, more or less the same case information actually given, guys. Next, come back. The next question is from AS7, construction of contracts. Direct question they tested. Direct question, which is question number 3 of our material. First, let me read the question given in the examination, guys. Come here. Question number D. So what they required, first let me read. Compute the contract revenue to be recognized. You know how to recognize the contract revenue? Total contract revenue into percentage of completion. That is the amount of contract revenue to be recognized in the current year. And calculate profit or loss for the year ended 31st March 2022. How to calculate profit or loss? Contract revenue to be recognized in the current year minus contract cost incurred in the particular year. In that particular year. The difference is nothing but profit or loss. And the additional provision for loss to be made, if any, for the year ended 31st March 2022. When there is an additional provision required, you know, the total estimated contract cost is more than the contract revenue, then you should need to create provision irrespective of the percentage of completion, whether work has commenced or not, even though if your contractor is getting profits from other contracts. We already read such provisions through AS7. Now, what the problem information? Fixed contract price with an escalation clause 35,000. Here it is given escalation in cost is by 8%. Accordingly, the contract price is increased by 8%. That means the total contract price considered should be 35,000 into 108%. This is the total contract price. Am I right? Next, work certified given, work not certified given. Sir, both are actually work executed by the contractor, but out of it 17,500 certified and 3,815 was not certified. And other information is given in the bracket. It includes 26,25,000 for materials issued, out of which material lying unused at the end of the period is 1,40,000. If any of the closing stock which is not utilized for the purpose of construction of the contract is excluded from the contract cost. So that's why out of 3,815, we should need to exclude 140 because rupees in thousands. To arrive or to derive the contract cost, the 140 closing stock of material you should need to reduce. Estimated further cost to completion given. Now percentage of completion, how much guys? Percentage of completion is 17,500 plus 3,815 minus 140 divided by 17,500. That is simply this figure plus 17,325. What is the formula for percentage of completion, guys? Cost incurred till date divided by total estimated contract cost to complete the contract. That is 17,500 plus 3,815 minus 140, which is 21,175 divided by 21,175 plus 17,325. That is 38,500. Numerator is 21,125. Denominator is 38,500. Percentage of completion. Percentage of completion is, I got 55%. Tell me, guys. $21,175 divided by 38,500, which is 55% is the percentage of completion. If you know the percentage of completion on such percentage of completion, if you apply on the contract price, then you know the contract price to be recognized in the current year. That is 35,000 into 108% into 55%. That is 20,790. First question answer is 20,790. Tell me, guys. That is the total contract revenue is multiplied with 108% into percentage of completion 55%. Calculate profit or loss for the year. Sir, for the current year, profit or loss is how much? Now, contract revenue recognized for the current year, you know, contract cost for the current year is how much? 21,125. Now, 21,125 is the contract cost and the contract revenue is 20,790. The difference itself is profit or loss, guys. 1 second, please. So if you check what is the difference, contract revenue 20,790 minus cost 21,125, which is the loss, guys. The loss is 335. So calculate profit or loss for the current year is, current year loss is 335 rupees in thousands, guys. Next, one more thing they asked, provision for loss to be made. How much for the current year? First, is it the total contract cost exceed the total contract revenue? Now you should need to check the total contract revenue. How much? 35,000 into 108%, which is 37,800. Total contract revenue is 37,800. What about the total contract cost to complete the contract? We got, which is 38,500, which is 38,500. So which is the total estimated contract cost? So the total estimated contract cost exceed the contract revenue. Now the total loss will be 38,500 minus 37,800. Total loss is 700. Out of such 700, current year loss you already recognize 335. So the remaining expected loss in the future is how much? 700 minus 335, which is 365, for which you should need to create a provision. Sir, just for discussing the answer, I discussed all such things, but which is the direct question given in our material, the relevant question number also given here, which is question number 3. If I open this in our material, come here, come to AS7. AS7 is 57 page number. You can open. Just a moment, which is 57. Where come to question number 3. If you check here, work certified, work not yet certified, estimated further cost for the completion, progress payments received to be received. So many questions actually I discussed in the classroom problem, but they asked only 2 questions: contract revenue to be recognized, profit or loss for the period, as well as provision. One additional thing they also asked, provision to be recognized. Tell me, guys. So contract revenue to be recognized is equal to total contract revenue into percentage of completion. Profit or loss for the current period equal to contract revenue recognized in the current year minus actual contract cost incurred. Provision is nothing but out of the total loss. If you reduce the current year loss, then you will get the expected loss for the future periods. For that, you can create a provision. That's it, guys. The same question, same to same. The only one difference, you know, the examination problem and classroom problem, the difference is this one. Closing stock of the material, you should not consider under contract cost. That point also number of times I emphasized while discussing the concept as well as problems. If you check here, yeah. Now you can check this. A contractor may have incurred contract costs that related to future activity on the contract. Such expenses are excluded from the contract cost. Examples I given here. Contract costs that related to future activity on the contract, such as cost of materials that have been delivered to a contract site, are set aside for use in the contract but not yet installed, used, or applied during the contract performance, which are nothing but closing stock, which should be excluded. Which should be excluded from the contract cost. The same point actually they tested, guys. The same point they tested in the previous examination and this examination also. In the previous examination, they asked a problem, which is problem number 8. If you observe this, which is question paper July 2021, that is one of the previous examination. They also actually mentioned material issued 21 lakhs, out of which materials costing 4 lakhs is still lying at unused, which should be excluded from the contract cost. The same thing now also discussed, 1,40,000, which is lying used at the end of the period, out of which material lying unused at the end of the period is 1,40,000, which should be reduced from the contract cost. That is the only highlight of this problem. Remaining all are as usual. Same question as like discussed in the classroom. Next, come down, guys. Come to question number 2. Amalgamation, 20 marks, guys. Very simple problem, as similar to problem number 5, which discussed in our classroom. First, let me open the examination problem. There are no much adjustment involved, but surprisingly they asked for 20 marks. Okay, so now equity share capital given, there is no preference share capital, securities premium, general reserve, P&L account, retirement gratuity fund, 10% debentures, unsecured loan, which is including loan from A Limited. Now unsecured loan from A Limited means for B Limited, in B Limited books, if you observe, long-term advance to B Limited is there, which is for 2,20,000. Long-term advance to B Limited. So advance given by A Limited to B Limited. For A Limited, which is an asset, for B Limited, which is a liability. Out of this 8,20,000, this 2,20,000 is there, which are intercompany owings. That means simply A Limited is payable to B Limited. For A Limited, which is a liability, to the extent of 2.2 lakhs. For B Limited, which is an asset, which is 2.2 lakhs. Now, during the process of amalgamation, the intercompany owing should be knock off with each other. Okay, trade payables, land and building, plant and machinery, inventory, trade receivable, cash and bank. B Limited is to declare and pay 1 rupee per equity share as dividend before the following amalgamation takes place with Z Limited. Now, in our classroom problem, what we discussed, B Limited is declared to issue the bonus shares. Here, just they pay the dividend. Here, they declare the dividend. There, in our classroom problem, we discussed about declaration of the bonus shares. Sir, now at the time of declaration of the dividend, what is the journal entry by the B Limited, guys? Now the profit and loss account should need to be reduced to the extent of 2,40,000 because they issued the dividend 1 rupee per equity share. Number of equity shares are 2,40,000. 2,40,000 into 1 rupee, 2,40,000. That's why there is a decrease in P&L account. And also there is a decrease in cash and bank balance. That is the impact. First, you should need to consider minus 2,40,000 in cash and bank, as well as minus 2,40,000 in profit and loss account as well, before making process of amalgamation. So Z Limited was incorporated to take over the business of both A Limited and B Limited. The authorized share capital of the purchasing company was 60 lakhs divided into 6 lakh equity shares of 10 rupees each. This is altogether a new company, guys. As per registered valuer, the value of equity shares of A Limited is 18 and the value of equity share of B Limited is 12 rupees per share. 10% debentures of A Limited to be issued to 12% debentures of Z Limited at par in consideration of their holdings. This is acquisition value of debentures of A Limited. Now, if you observe in A Limited books, debentures are there. At which price actually these are acquired by the purchasing company, given through point number C. A contingent liability of A Limited of 2 lakhs is to be treated as an actual liability. Now you should also consider this liability is taken over by purchasing company. Liquidation expenses including registered value or fee of 50,000 and B Limited 30,000 respectively to be borne by Z Limited. If the realization expenses are borne by the purchasing company, what is the journal entry, guys? Goodwill or capital reserved to bank in the books of the purchasing company, but in the books of the selling company, no entry. Tell me, guys, we already seen this is liquidation expenses adjustment they tested. The shareholders of A Limited and B Limited is to be paid by issuing sufficient number of fully paid up equity shares. Sufficient number of fully paid up equity shares. By reading the information given in the problem, are you able to find how many number of equity shares payable to the selling companies? No. Then the PC is under NAV method. PC is under NAV method. Consider all assets taken over and all liabilities taken over at agreed values. Liability means including this contingent liability of A Limited, and liability means including the liability of the 10% debentures. Then you can calculate NAV of A Limited and NAV of B Limited. Now, how many number of shares issued to A Limited and B Limited? How can I know? For A Limited, each share is 18 rupees, and for B Limited, each share is 12 rupees respectively. Am I right or wrong, guys? So, one second. So the PC is under NAV method, guys. But if this point is missing, then PC is equal to NAV method. But from the given information in the problem, we can able to ascertain how much amount we can payable to the equity shareholders of A Limited, how much amount payable to the equity shareholders of B Limited. We can know. Tell me, guys. That's why PC is under not under NAV method. PC is under net payments method. Do you understand, all of you? Sir, now value of equity shares of A Limited is given at 18 rupees per share. How many number of equity shares are there in A Limited? Total 3 lakh equity shares are there. Now 3 lakhs into 18 rupees is the amount payable to equity shareholders of A Limited. Then amount payable to equity shareholders of B Limited, 2.4 lakhs into each equity share price value is how much? 12 rupees per share into 12. These are amount payable to equity shareholders of A Limited, amount payable to equity shareholders of B Limited. If you make it total, then you will get PC. PC is under net asset. Sorry, PC is under net payments method. But if such information is missing, then PC is under NAV method, guys. That is the important point. Next, sir, how many number of shares issued as PC? How I know? It is clearly given that the shareholders of A Limited and B Limited is to be paid by issuing sufficient number of fully paid up equity shares of rupees 10 each at a premium of 10 rupees per share. That means purchasing company is issued each and every share at the rate of 20 rupees per share. That is 10 rupees face value, 10 rupees premium. If you make it divide by 20, then you will get how many number of shares as issued as PC to A Limited. If you divide by 20, how many number of shares issued as PC to B Limited, you can know. Okay, fine. PC calculation is pretty much easy here. Assuming the amalgamation is in the nature of purchase, number of times I already told you, the nature of amalgamation directly they mention in the examination problem. You are required to pass the necessary journal entries. Narrations not required in the books of Jet Limited, that is in the books of purchasing company, and prepare the balance sheet of Jet Limited immediately after the amalgamation of both the companies. First, business purchase to liquidator of A Limited and business purchase to liquidator of B Limited. Here you need to pass acquisition entries at twice. That is acquisition of A Limited, one set of entries, acquisition of B Limited, another set of entries. For both the acquisitions, entries are same, but the amounts may change. And one more thing, you should need to compare PC with NAV as well. Anyway, even though PC is under net payments method, you cannot escape from calculation of NAV. Now, the PC you can compare with NAV. If PC is greater than NAV, which is goodwill. If PC is less than NAV, which is capital reserve. That point also you should need to work out in the second entry. Then third entry, that is liquidator of A Limited to equity share capital to securities premium, liquidator of B Limited to equity share capital to securities premium. Then intercompany owings are there, na? Intercompany owings 2,20,000, and from here also 2,20,000 you can cancel with each other. That is unsecured loan account debtor to long-term advance to B Limited 2,20,000. The balance sheet at the time of preparation of balance sheet from unsecured loans, you need to reduce 2,20,000, and this long-term advance to B Limited should not be shown in the balance sheet. Am I right, guys? Now, after passing this, you should need to prepare the balance sheet. But at the time of preparation of balance sheet, what is the authorized share capital of the Jet Limited? 60 lakhs. How much share capital you can put? The share capital amount to the extent of face value, you should need to put. PC you should na. PC at, that is, here number of shares you work out na. Divided by 20, you will get number of shares into 10 face value, into 10 face value. If you make it club, that is the total share capital need to shown in the balance sheet. Am I right, guys? Next, one more thing, which is amalgamation in the nature of purchase. That's why reserves and surplus of the selling company should not be taken over by the purchasing company. All these reserves should not come into the balance sheet. But which you need to check, if while comparing PC with NAV, if PC is less than NAV, capital reserve will coming into the picture. Such capital reserve you should need to consider. But if it is the goodwill, obviously you can ignore that. Guys, today morning actually, suddenly I'm suffering from cold since today morning onwards. Outside, which is almost at 40 degrees Celsius, I know, but I don't know. There may be some water change in and around last 10 to 15 days. I was in the outstation audits completely. My schedule was completely engaged with outstation audits. Maybe that is the reason, due to change in the water in the body. So in between any disturbances are coming, please bear me, guys, with respect to my voice or any other problems. Okay, fine. This is all about amalgamation problem, guys. So nothing is great here. All are known adjustment. PC is net payments method only. So while comparing PC with NAV, you should need to recognize goodwill or capital reserve as well. This is all about amalgamation problem. The similar problem I already told you, we discussed in our material through problem number 5. Just a second, I'll open that. If you check here, before process of amalgamation, one of the selling company issued bonus shares. So in our material, before the process of amalgamation, one of the selling company issued the bonus shares. After that, one purchasing company take over the business of the selling company, then the remaining issues are just there given. So the similar problem actually they tested, but the only difference is they issued the dividend but not the bonus shares. Okay, there are not much adjustments involved. That is, one adjustment is liquidation expenses, and another adjustment is intercompany owings, and the remaining all are normal. Just a second, let me open with examination question. Where it is? Yeah. So this is all about amalgamation, guys. Next, come to the next question number 3, which is consolidation. So question number 2, hope you understand. So the few important adjustments are this liquidation expenses adjustment, goodwill to or capital reserve to bank, you should need to work out. And another one, the common 3 entries here: business purchase to liquidator, assets to liabilities to business purchase, goodwill or capital reserve you should need to incorporate, liquidator of selling company to equity share capital securities premium, and this liquidation expenses adjustment entry. And for the debentures of the selling company, you should need to issue your own company debentures. At that point of time, premium or discount you should need to work out. And intercompany owings are there. For such intercompany owings, another entry. 3 main entries, 3 adjustment entries, total 6 entries. Okay, then balance sheet. But acquisition entries for both the companies, you should separately work out. That is the reason why actually they given for 20 marks. Then finally, you should complete the balance sheet. Then come to question number 3, which is related to consolidated balance sheet, guys. What they asked, let me check here. You are required to prepare consolidated balance sheet of the group as on 31st March 2021 as per the requirement of Schedule 3 of the Companies Act 2013. 4C approach. Now, if you observe, the information is given as on 31st March 2021. Date of acquisition is 1st October 2020. Number of shares acquired were 2,250 in Black Limited. That is out of 3,000 shares. If 2,250 were acquired means 75%. Holding interest 75%, minority interest 25%, date of acquisition 1st October 2020, date of consolidation 31st March, which is first C, cutoff data. Then classification, you should need to classify the reserves and surplus of the subsidiary, that is Black Limited, into capital profits and revenue profits. Now, out of this general is a 30,000, how much capital profit, how much revenue profit? Out of this 90,000, how much is the capital profit, how much is the revenue profit? Now, if you observe, they given reserves and surplus as on 1st April 2020. So reserves, you need to check only the reserves and surplus of Black Limited. This is irrelevant for us. Am I right? So Black Limited, if you check, reserves opening 30,000 is given. That means entire this 30,000 is capital profits only. Coming to the profit and loss account, out of that 90,000, Black Limited 10,000 loss is there at the opening. This 10,000 loss is capital loss. Not only that, one more thing you should need to check. If this is 10,000 loss, then current year, how much profit they got, you know? Current year 1 lakh profit they got, because 10,000 loss, which is the capital loss. And out of this 1 lakh profit, pre-acquisition and post-acquisition, you should need to check. Pre-acquisition is for 9 months, 9 or 10 months. Because 1st October means 9 months. 9 months is the pre-acquisition profits, 3 months is the post-acquisition profits. Accordingly, you should need to split the pre and post-acquisition. Then you know the capital profits and revenue profits. Then after classification, then you should start with calculation of minority interest, then cost of control. There are no intercompany owings here. That's why there are no mutual owings. Then you can go for consolidated reserves and surplus. Then finally, you can prepare the consolidated balance sheet. There are no much adjustments involved. Only one adjustment, guys. During the year, Black Limited fabricated a machine which is sold to White Limited for 39,000. The transaction being completed on 30th March 2021. Sir, the transaction was already completed and they considered here. No need to adjust anything. This is just a additional information given. Cash is transit from Black Limited to White Limited was 6,000 on 31st March 2021. So Black Limited to White Limited transmitted means due from Black Limited is there, right? Due from Black Limited. In case of White Limited, the cash was already transmitted by White Limited means 6,000 you need to reduce here. Then this balance will become 30,000. The cash in transit will become plus 6,000 means, which is 45,000, guys. Because the cash was transmitted ultimately by Black Limited to White Limited. Now in the books of White Limited, still you are not shown as a 36,000 due. 6,000 was already in transit, means you need to reduce. Only 30,000 is the due amount from the Black Limited. So that's why that 6,000 you should need to include in the cash and cash equivalents. That is the cash in transit adjustment, guys. Okay, that is not the consolidated adjustments. In generally, at the time of preparation of financial statements, if any transits are there, then you need to reduce from the debtors and you need to add it to the cash and cash equivalent. The other party they already adjusted. That is the reason why actually due to White Limited they represented at 30,000. Due to White Limited 30,000, after adjustment of the cash in transit, this balance also will become the 30,000. Now during the process of consolidated balance sheet, it will be nullified with each other as well. In the mutual owings, this one is there. I told that nothing is there now, but this one is there. This adjustment will you should need to made under chart number C. Okay. What about the remaining guys? Remaining all are normal. That means simple the 4C approach. If you follow, everything will come. One is cutoff data, another one is classification, and another charts preparation, chart A for minority interest, and chart B for cost of control, and chart C for mutual owings, and chart D for consolidated reserves and surplus, and final C is for consolidated balance sheet. The same way you can make it present. Nothing else, guys. Apart from that, there is no other important information given there. Next, come to question number 3B. Write a short notes on non-performing asset of the banking company. Elaborative discussion I made, and the same thing was there in our material as well. So when an asset is said to be non-performing asset, non-performing assets are other than performing assets. Then what is meant by the performing asset? Performing assets are those assets which does not create any problem except in case of the business risk. Sir, non-performing asset, when you can recognize as a non-performing asset under different assets classification, we discussed for agricultural advances, that is long crop, short crop, in normally for greater than 90 days in case of advances, and in case of that is cash credit or OD facilities, CCR OD facilities, when it is termed as non-performing asset. Tell me guys, all such issues we discussed with the same thing, you can give a short note. Okay, I'll open the banking companies. Just a moment here. So come to the last page, I think so. Here I'll show the non-performing asset concept. Initially we discussed it, right? Yeah, here it is there. If you observe, sir, NPA is other than a performing asset. Then you can tell what is the meaning of performing asset. When bills purchased and discounted is known as NPA if it exceeds 90 days. In case of term loans, if it exceeds 90 days. Cash credit or OD, when it is termed as an NPA, the outstanding balances remains continuously in excess of the sanction limit or the drawing power for a continuous period of 90 days. Or maybe it is less than the sanction limit or the drawing power, but there are no credits to cover the interest prior to the date of balance sheet. There are no credits, or else credits are there, but those are not enough to cover the interest at all. Then we can treat those are non-performing assets in case of CCROD. Sir, why I'm discussing CCROD in detailed way? Because the sub question they asked about, that's cash credit only. Two accounts are given, account A, account B. Now sanction limit is 4,500, drawing power is 4,200, amount outstanding was 3,600, total interest debited for the above period is 288, the total credits for the above period is 120. The amount of credits is not enough to cover the interest. That's why which is an NPA, which is for NPA, and which is for greater than 90 days. Next, coming to account number B. Sir, interest debited was 315, but the total credits for the above period was 380. So that's why credits are in excess of the interest debited. That's why which is not an NPA. Account number A is an NPA. Account number A is an NPA, but account number B is not an NPA, which is not an NPA. So you can clearly write the NPA definition in case of cash credit or OD. Then you can give the answers of sub question number B. This is all about question number B, guys. Sir, which is a direct question which we discussed in our classroom also. That is, I think so, question number 3, I think so. Let me open question number 3 in our material. Sir, if you are observing, for every question in the examination, I am opening a question in our material. There you can simply realize that how our entire material is enough to cover the examination. Okay, and you can understand our material strength as well. Okay, right, just a moment. Yeah, there, question number 3, you can check sanction limit, drawing power, outstanding, total interest debited, then give your comment whether the above credit facility is NPA or not. The same to same question actually just now I read, but two different cases are given. Fine. So guys, due to my uh, illness, due to my little bit illness, sometimes I'm unable to concentrating at the time of reading the question. So please give your concentration from your side, guys. I'm only telling the outlines of the question. Uh, in fact, I'm not talking properly as well, but just I want to deliver this question paper analysis on time. That is the reason just I want to provide this. Okay. So if any time here and there I will go, so please bear with me. So next question is question number 4, guys. Question number 4 is related to partnership accounts, right? Question number 3 is CFS for 15 marks, banking companies, NPA and cash credit. And question number 4, partnership Garner versus Murray's case law, just they tested for 15 marks, guys. Sir, how you know this is Garner versus Murray's case law? It's very simple. Here Sanjay's capital was given, which is 40,000, right? Which is 40,000. Now, at the end of the information, it was found that the realization from the Sanjay's private assets would be 7,000 only. That means Sanjay's private assets are not enough to recover from the Sanjay's balance under the partnership firm, because Sanjay's balance itself here itself given as a debit balance. If one partner is insolvent, then the such partner should be treated as a insolvent, right? Because his assets are not covered to recover from his debit balance of the capital. Then Sanjay is said to be insolvent partner. Whenever one insolvent partner is there and the other partners are solvent, then Garner versus Murray's case law is applicable. Then the insolvency loss caused due to insolvent partner should be borne by the solvent partners in their capital ratio, and to that extent of the realization loss also they should introduce in the form of cash. Such 2 points you should need to work out. Sir, which approach you need to follow? DDTT, Garner versus Murray, and yes for settlement. Sir, if you are my student, then only these things all are applicable, because D4, disbanding of balance sheet. Another D4, disposal of assets and liabilities. T for takeover of asset and liability by the partner. T for transfer of realization profit or loss to partner's capital. Then apply the Garner versus Murray's case law. Second rule first, that is to the extent of realization loss, you can introduce. Then Garner versus Murray's case law first rule, that is insolvency loss caused due to solvent partner should be borne by the insolvency loss caused due to insolvent partner should be borne by the solvent partners in their capital ratio. Then final settlement. For this, you need to open the realization account, cash account, partners capital accounts. The same 3 things actually they asked to open: realization, cash, partners capital. If you simply follow these steps, DDTS, automatically the problem is over. But one special point they added, you know what that special point? Before this balance sheet is drafted by the following frauds committed by Sanjay. That means this balance sheet is not the accurate balance sheet. You should need to work out the accurate balance sheet before applying this DDTTS approach. Now, what is the accurate balance sheet, sir? You need to adjust the following frauds made by Sanjay. For example, one fraud, just I'm telling here, investment costing 8,000 were sold by Sanjay at 11,000 and the funds were transferred to his personal account. This sale was omitted from the firm's books. This is altogether omitted. Now, what is the entry actually? Bank account debtor 11,000 to investments account 8,000 to P&L account 3,000. This is the entry, actual entry. And this bank balance was already taken by Sanjay personally. That means Sanjay's capital account we should need to reduce. That is Sanjay's capital account debtor to bank account. Now bank cancel, then Sanjay capital account should be debited with 11,000 and investment account should be reduced with 8,000 and P&L account should be added with 3,000. Now what are the adjustment here? Sanjay's capital debit balance, you can add here 11,000. Next, investments you can reduce here with 8,000. The net impact plus 11 minus 8, 3,000. For such 3,000, you should need to add P&L account 3,000. That P&L again belongs to the partners Ajay, Vijay, and Sanjay. That is different story. Do you understand? Like this, you should need to consider each and every fraud made by the Sanjay into the balance sheet before applying this DTTTS and Garner versus Murray and settlement system. Then after adopting these frauds into the balance sheet, then you can apply the DTTS approach. Then automatically this partnership accounts problem is over. Do you understand? That is the only special step actually they added here, guys. That is all about problem number 4A. Then come to problem number 4B. Sir, explain the nature of a limited liability partnership. Who can be as designated partners in the limited liability partnership and what are their liabilities? At the time of discussing LLP, I clearly told you every time they're asking question from the LLP, which is a theory question. The same to same concept I discussed, and we almost spent more than 1.5 hours in the classroom for discussing things related to the LLP. If you want, I'll open, just give a moment. So partnership accounts, this is 192. If you open the page number like 185, then you will get it. Yeah, you can check here, guys. What is the nature of limited liability partnership? Everything I discussed, almost 7 points I discussed, 7 to 8. No need to write all such points. You can mention 3 to 4 points. Okay, limited liability partnership is a body corporate. Limited liability partnership should have a perpetual session. Limited liability partnership should not affect the existence of rights and liabilities. As per section 7 of the LLP Act, every limited liability partnership should have at least 2 designated partners who are individuals and at least one of them should be a resident in India. That question also asked, who can be a designated partner in an LLP? Individual, and minimum should be 2, out of which one should be resident of in India. Next, what are their liabilities? Liabilities of the designated partner, A and B, 2 points are clearly given. Do you understand, guys? This is all about question number B. So totally till now we discussed total 4 questions. Now come to question number 5. Question number 5 is all about, one second. Question number 5 is all about, just a moment, guys. This is not redemption of preference shares. Question number 5 is related to buyback of equity shares. Buyback of equity shares. So what they given? Assuming that entire buyback is completed by 31st December 2021, pass the necessary accounting entries in the books of the company in each situation. What is the situation? You are required to compute the maximum number of shares that can be bought back in the light of the above information and also under a situation where the debt funds are 1680 crores and 2100 crores. Total 3 tests are there, na? Debt equity ratio test, outstanding shares test. Tell me, guys. You should apply total such 3 tests for this case and for this case. Then you will know the maximum number of shares bought back under this situation, under this situation. Once you can finalize the maximum number of shares bought back, then you can pass the necessary accounting entries. That is equity shares bought back accounted are to bank account. Then if it is with premium, equity share, then equity share capital accounted are premium on buyback accounted are to equity shareholders account. Then premium on buyback you can set off with profit and loss account. Tell me, guys. Such all entries you can pass here. And the similar problem we already done. I'll open that problem. I don't want to discuss each and everything here, which is problem number 9. Just I'll open the same to same. There is only change in the names of the companies. The remaining is as it is, guys. As it is. Just a moment. I'll open that. So buyback of equity shares is 235 to 249, which is given. So if I open 249, there I think so, which is the last question, guys. So what is the question number I mentioned? Question number 9, right? Yeah. So you can come to problem number 9 here. Sorry, it's not a problem number 9. 1 second. It's a problem number 3, I think so. Yeah. So you can check here, guys, which is problem number 3. 1 second, which is problem number 3. What is this, sir? Please check here. There are two situations given. One is debt funds 1,200 crores. One is 1,500 crores. Assuming the entire buyback is completed, so and so companies in each situation. You should need to provide the journal entries in each situation, accounting entries in each situation. The same information in the prevailing market company share is 25 rupees per share. In order to induce the existing shareholders to offer their shares for buyback, it was decided to offer a price of 20% over the market. The similar lines you can found in the examination paper as well. So 20 per share, company share is 20 per share. In order to induce the existing shareholders to offer their shares for buyback, it was decided to offer a price of 50% over the market value. That is the reason why I'm not explaining this. The same to same question, guys, which is print, copy, paste. 10 marks is direct question. Come here. Question number 5B, Deluxe Commercial Bank. They asked to find out CAR ratio, capital to segregate capital fund into tier 1 and tier 2 and find out the risk adjusted asset and risk weighted asset ratio, which is also the direct problem, guys, from banking companies. Problem number 19. I'll open the problem number 19 in the banking companies. Come here. Come to the problem number 19. If you observe, the problem is all about segregate the capital funds into tier 1 and tier 2 capitals, find out the capital to risk weighted assets ratio, which is a direct question. That means question number 5 is completely direct question. That is the reason I'm not explaining anything. Next, come to the question number 6, which is the last question, guys. One by one, let us have a look quickly. Then we can liquidate this session. Answer any 4 of the following. This is from segment reporting. They asked to find the reportable segments or the non-reportable segments. Totally 3 to 4 tests are there. Out of this, segment result-based test. Segment result-based test. So you can make it the totals of the positive results and the negative figures in the absolute manners. Then out of which each and every result, if it is greater than total of the 10% of the consolidated result, then you can take it as a reportable segment. Then for example, here 225 plus 25, which is 250. Here it is 195 plus 105, 300. So in absolute manner, 300 is big. 300 into 10% is that equal to 30. If it is greater than 30, yes, this is a reportable segment. It is not a reportable segment. It is not a reportable segment. Sorry, it is reportable segment. It is less than 30. It is not a reportable segment. It is a reportable segment. Out of B and D are non-reportable segment. Remaining segments are reportable segments. This is very simple question. We already made, or we already done such type of questions in our classroom as well. Sir, this question number of times they are testing, sir. Since from the last 3 to 4 attempts, the similar question actually they are asking from shares with differential rights. You need to calculate the relative ratio. Find out the relative weight in the voting right of the equity shareholders and preference shareholders. If in a single meeting, both equity shareholders and preference shareholders will participate, how to calculate the voting right? The same to same question is there, which I mentioned the question number also. Just give a moment. I'll open that. Question number is problem number 7. Equity shares with differential rights. The question is from equity shares with differential rights. 249. You can open directly page number 249. You can directly found that question. So this is the question. So WXYZ are the equity shareholders in that ratio. ABCD are preference shareholders in that ratio. Then you can find the paid up capital of the company is 40 lakhs and preference share capital is 20 lakhs. Find the voting rights in case of resolution of the winding up of the company. Here also you can find the similar ratio, guys, because the reason is preference shareholders are not getting the dividend for more than 3 years. Then preference shareholders will have a right as equal to the equity shareholders. That's why in a particular meeting, preference shareholders will also participate along with the equity shareholders. And another question is, I expected in the examination in the classroom itself, I told, I think so in the RTP also they tested the same question. What are the conditions we need to fulfill at the time of issuing differential voting rights? that is shares and debenture rules 2016, I think so. Such rules also we explained here. I'll open such rules. Sorry, 2014 share capital and debenture rules 2014. Okay, so that the differential rate shares should not exceed 26% of the total shares. These are not default in the payment of deposits or the redemption of preference shares. The company has not defaulted in filing the financial statements and the annual returns. Company having the consistent track record of distributable profits. The issue of the shares is authorized by an ordinary resolution. The articles of association of the company authorizes. If such all conditions satisfied, then we can issue the equity shares with the differential rights. I discussed such concept also by allocating the proper time in the classroom, if you're really remembering. Do you understand? This is all about question number B, guys. Honestly, I need to accept one fact, guys. What are the disclosure requirements for operating lease by the lessee as per AS 19? In AS 19, we never expected this type of questions because a lot of important concepts are there. That's why intentionally I skipped the disclosure requirements in AS 19 while discussing the concept of AS 19. But that is the level of CA examinations. But one unexpected question, if anything, is there in the entire question paper. This is the question paper. I honestly accept this disclosure requirement was not discussed by me in the classroom. I think so, not only by me, any of the faculty throughout India, he may not discuss such question because a lot of big and important concepts are there in accounting standard 19. Who gave the importance to the disclosures at that point of time? But I allocated much time to discuss the disclosure about other standards, but I didn't allocate any single minute to discuss about the disclosures related to AS 19. But anyway, this time I will include that. But I think so, this may not repeat in the future for further 10 to 15 attempts. That's why it is better to ignore. Anyway, this is a choice question. You can take a choice out of the 5 questions. You can write the 4 questions. That's when nothing will happen to us. Next, coming here, this question is all about preparation of the liquidator final statement of account. This is all about preparation of the liquidator's final statement of account, guys. Sir, liquidator of final statement of account, we see number of problems, but the specialty of the problem is how you can distribute amount among the different equity shareholders, having the paid up values are the different, as well as face values are also different. If the face values are the different, if the paid up values are the different, how you can distribute the cash among the different equity shareholders, we seen through a one problem. In the liquidator final statement, just they clubbed this information, but we exclusively seen how to distribute money among the different equity shareholders. I'll open that problem. You can directly see that, which is problem number 7 in the liquidation final statement. Page number 120. Where you can see in that. Yeah, this problem. This is face value equal. Yes, this problem number 7. If you check face value is different and paid up value is also different, then how you can distribute the surplus among the different equity shareholders we seen. So just they included such point in the examination problem. Apart from that, remaining all things also given. That is calls in arrears are 3 lakhs and calls received in advance 2,55,000. Preference dividends are in arrears. Sir, in the order of preference, first you should make payment to arrears of preference dividend. Then calls in advance to the equity shareholders. Then you will get the remaining balance, right? That remaining balance, how you can distribute among the equity shareholders. That thing I told you. First, preference. Once again, I'll tell you the order first. Out of the surplus of this amount, first you can pay the arrears of preference dividend. Then preference dividend capital. Then preference dividend capital is there, right? Such preference dividend capital you can pay. After that, calls in advance you taken from the shareholders. After this, the remaining balance is there na surplus. Such surplus, how you can distribute among the equity shareholders. For that, you can apply the concept of this problem. Then automatically liquidator final statement is over. This is all about liquidator final statement. Sir, I thought that which is not a 5 marks problem, but surprisingly, this was asked for 5 marks. Actually, this is actually a lengthy problem. Next, coming to question number G, you are required to pass the journal entries for ESOP, guys, which is employee stock option plan, which related to the post vesting restrictions. Direct problem is there, guys, whether you believe me or not. Direct problem number 8. I'll open this ESOP 234. Page number is for 234, which is the last question, guys. Problem number 8. Here, if you observe, post lock-in period is there. The market price of the shares of the company on the grant date is 60 per share. Due to post vesting restrictions on transfer, the fair value of the shares issued under the plan is estimated so and so price. The similar terms, they are used in the examination question paper as well. If you check here, the employees are given a year to accept the offer, subject to a lock-in period of 3 years from the grant date. The market price is 60 per share, and the fair value of the shares is 56 rupees per share. So almost same. There are no change at all here. Cut to copy paste. Cut to copy paste. That's it. The only difference is here something 500 shares or something it is given, but in the examination problem it is given at 100 shares for 5,000 employees and something is given. So you are required to pass the general entries by applying such problem knowledge. That's it. Sir, now what you can tell after checking this entire question paper, sir? At the inception of the question paper analysis itself, I made one comment. More than 90 marks of this question paper are direct questions from our material. Not, I cannot tell like that. Our material was derived from the study material itself, greater than 90 marks itself directly from study material itself. That's why every time I'm pushing you guys, please practice the entire problems from the study materials. Don't make it practice from authors and such all different persons. Always our Bible will be the study material. And even maybe some of the questions may ask from the direct concepts given in the study material, which might discussed in the classroom environment. They might change here and there. They might add 1 point less and 1 point more. There you should need to apply your mind. There we cannot mug up the concept. Sir, study material problem number is there. That additional change is there now in the examination problem. Yes, they might give such additions and deletions. That and all are part and parcel of examination. Hope you are enjoying this lecture, and after watching this lecture, your people perception, they might change. How the preparation style should need to be changed according to the examination criteria, and what are the mistakes. If you've done anything, you can cross verify, and the level of attitude you should need to require while at the time of presenting the answer. Such all things you might aware through this video lecture. And please kindly accept me, guys. I'm suffering from cold here and there. If my voice is changed, if some other issues are happen, please kindly accept me. I gave 100% of efforts to explain in detail and better manner. Have a good day, guys. Hope you are qualifying your examination with flying colors. Bye bye. Have a good day.